Welcome back to the channel, everybody. I'm Jay from Investonomics, and it's that time of the week again. It is lecture time. So this week we're going to be covering the topic of cryptocurrencies. I'm going to be giving you guys some advantages and disadvantages of using cryptocurrencies online, and also giving you some insight into using it as an investment vehicle. So hope you guys can learn something today, and I'll see you all next week. Welcome back, everybody, and today I'm going to be covering the pros and cons of cryptocurrency. Cryptocurrencies have become a new craze in the investment world, as I'm sure many of you are aware of. This is especially true for its most popular player, which is Bitcoin. So the past 12 months have yielded well over 160% returns. In fact, this data is old as it seems, but you can see here from the graph, from a low of $4,000 in March of 2020 to $65,000 mid this year, which is insanity. So this spike is found to be due both to new traders and investors entering the markets with the onset of COVID-19, but also with the popularity of being able to pay online with ease using cryptocurrencies. So some examples of this are using PayPal and Square, and they now accept payments of Bitcoin, and even companies such as Tesla, which have started accepting it, but there's still some controversy with it. At their very foundation, a cryptocurrency is a currency like any other, but it's decentralized, and that's the key here. And therefore means it's secured using a process called cryptography. And this serves to mitigate fraud and reuse of the same coin twice, kind of the same way as we would print our own money with real currencies. Cryptocurrencies are decentralized and are therefore freestanding and don't have the ability to be affected by the government or central banks, which is very important. So instead of this, they're actually governed by a network of computers. And this can be people like you and me or companies. And together, they are further secured and anonymized using different blockchain technologies. Essentially, what a blockchain does is organizes the data needed for various transactions to happen and ensures that they're secure and safe. And this is really important because they're not on a regulatory authority. This has led to the idea of widespread adoption of blockchains throughout finance, and because they're so easy to implement. The initial idea of Bitcoin was introduced by Satoshi Nakamoto, which was further adopted by all other cryptocurrencies, is that they restrict manipulation from government and other central authorities in order to determine their value. Cryptos are not affected by these forces, as I've said before, and one advantage is there's no effects of inflation, which is a rising worry and concern for many Americans and Canadians with COVID-19. In 2009, Bitcoin was the only cryptocurrency, but since then, thousands of other copycats and alternative coins, also termed altcoins, have joined the cryptocurrency space and the markets. Purchasing platforms such as Cash App and Coinbase have made their access even greater for online purchases and transactions, making it even more popular. As of August 2021, there are 18.8 million Bitcoins in circulation, but the total number of Bitcoin is capped at 21 million. So this eliminates the risk and the ability to add and reduce the amount of Bitcoins, which means that there's no risk for inflation because we can't print Bitcoins. So new Bitcoin are mined by individuals or corporations with powerful computers, and they're compensated in Bitcoins. And I'll do a future video on this because it's a very complicated process. We'll take a look at some advantages and disadvantages of cryptocurrencies. So the first advantage is that they have a high rate of return versus stocks, and this is historically true. Second is that there's no need for a third party like a bank for online transactions in order to secure them, and this is because they use private and public keys to do this. Transaction fees are very low using Bitcoin, and it's easily traceable for illegal activity. And very important is that the government cannot access personal information. This is very valuable. Another one is that any amount is sent instantaneously anywhere in the world and from anywhere in the world. And finally, they're a great solution for corporate deals because of their low-cost structure. Some disadvantages are that transactions are secure, but also anonymous. And this anonymity allows facilitation of illegal activity, such as money laundering or tax evasion, to happen fairly simply. Funds can also be lost by destroying a hard drive or by losing a private key by the person who holds the funds. Supply and demand also governs the exchange rate, not normal currency forces, and this is very different from what most people are used to with Forex. There's also great volatility, but means the price in Bitcoin alters rapidly, which can be a pro or a con. And there's still bugs to find and fix, but nobody can contact if that happens. So now in terms of an investment, economists argued it is a stage of being in a speculative bubble due to the novelty of cryptocurrency, but it may become more stable down the road and over many years when it becomes more normalized. Despite this opinion, others say that it's a great investment because it will appreciate over time due to its limited supply, and this is very real by the laws of economics. And it also offers inflation protection, and this is especially true in the coming years due to COVID-19 inflation that will likely set in. A popular way to invest in cryptocurrency hasn't been directly by buying cryptocurrency, but rather by way of mining for Bitcoin and various altcoins. Individuals can earn a passive income by mining for new Bitcoin or securing transactions by verifying them. However, this requires a very powerful computer setup. But by doing so, they can earn Bitcoin and have a passive income this way and further develop the blockchain so that counterfeit is less likely. Overall, investing in cryptocurrency comes down to your appetite for risk due to the insane volatility and swings that you'll experience, and what returns you seek as an investor. Cryptocurrency may offer a very unique addition to a growth portfolio in that it is inflation protected and is not affected by the government or central banks. Essentially, this means many crashes can potentially be avoided if they're linked to national agencies as the cause, such as the 2008 financial crisis. Finally, the liquidity of cryptocurrency as well as its volatility is very attractive for short-term traders who look to profit from smaller market moves and scalp the moves. The large liquidity also offers easier sale and buying of cryptocurrencies, and this means transactions take place much faster. There's also no settlement wait times when funds are made available by the sale of cryptocurrencies, which is also a bonus. So I'll see you guys next week.